Hello. Welcome to this week's Private Funds Update. I'm Sandra from SmartEsq. Let me share with you what I learned this week. Our lead story. The U.S. Treasury Department and IRS have proposed repealing a critical tax rule affecting foreign investment in U.S. real estate, a move that could fundamentally reshape cross-border real estate fund structures. The agencies are proposing to eliminate the look-through rule for domestically controlled REITs under the Foreign Investment in Real Property Tax Act, known as FIRPTA. Currently, this rule provides that foreign investors can dispose of stock in a domestically controlled REIT without triggering FIRPTA withholding taxes, even though the REIT holds U.S. real property. Here's why this matters. FIRPTA generally imposes withholding taxes on foreign persons when they sell U.S. real property interests. The look-through rule has been a cornerstone planning tool, allowing foreign investors to access U.S. real estate markets through REIT structures without the burden of FIRPTA taxation, provided the REIT is domestically controlled. The proposed repeal would eliminate this favorable treatment, potentially subjecting foreign investors to withholding tax even when investing through domestically controlled REITs. This could significantly reduce returns for non-U.S. investors and make U.S. real estate investments less competitive compared to other global markets. For private equity real estate funds with foreign limited partners, this change requires immediate attention. Fund managers must evaluate existing REIT investments, model the tax impact on foreign LPs, consider restructuring options before any final rule takes effect, and potentially adjust future fundraising strategies if U.S. real estate becomes less attractive to international capital. From the United Kingdom, the Financial Conduct Authority has launched a comprehensive review of consolidation in the wealth management sector, a market where private equity has been extraordinarily active. The FCA is examining how PE-backed consolidation is affecting consumers, competition, and market structure. Areas of scrutiny include consumer choice, advice quality, pricing, and concentration risks. For private equity firms with wealth management portfolio companies or considering acquisitions in this space, expect potential new rules governing consolidator business models and enhanced consumer protections. This signals growing regulatory concern about private equity's expanding role in retail-facing financial services. Third, the Australian Securities and Investments Commission has announced expanded surveillance of private funds, marking a significant regulatory shift in the Asia-Pacific region. ASIC will increase monitoring of private equity and venture capital funds, focusing on valuation practices, fee transparency, conflicts of interest, and investor treatment. This heightened scrutiny reflects concerns about rapid market growth and regulatory adequacy. Fund managers operating in Australia should prepare for detailed regulatory inquiries, potential examinations, and enhanced reporting requirements. This represents an ongoing surveillance priority, not a temporary initiative. On the deal front, the European Union's Artificial Intelligence Act is creating new due diligence obligations for private equity investors across Europe. The Act classifies AI systems by risk level and imposes requirements on high-risk system providers and deployers. PE firms must now assess whether targets develop or use AI systems, determine risk classifications, evaluate compliance status, and quantify remediation costs and liability exposure. This extends beyond pure technology companies. Many traditional businesses now use AI in operations. Deal teams must integrate AI-specific technical, legal, and financial analysis into pre-closing diligence, as penalties can reach millions of euros. That's it for this week. You can learn more about these topics from me on the SmartEsq platform. If you are curious about the services we offer, please visit www.smartesq.ii.